Hello and welcome to the week ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index, looking ahead to the week beginning 20th of October. So as always, I'm just going to ask you to have a quick read through the risk warning. I'll put myself on mute whilst you do this. Okay, so let's just start by having a quick recap of what has been happening this week. If you have a look here, this is where we are. This is the S&P 500, has actually recovered some of the earlier losses, but we are looking at a loss across the week for the S&P 500. We've fallen quite sharply in the last session or two, and this is basically we had quite a lot for markets to digest this week. First of all, there was the ramping up of the US-China trade war rhetoric, or at least trade tensions. That kicked off last Friday with Trump warning of 100% trade tariffs with China over the weekend. On Friday, sorry, after the market closed, and then that actually resulted in a little bit of a reining in of that sort of aggressive rhetoric over the weekend. But then it feels like across this week, there has been concerns over the ramping up of the trade tensions between the two sides. Trump sort of talking about withdrawing cooking oil and from trade from China, as China refusing to buy the soybean from the US. So that does mean we've had trade tensions. We've also had this ongoing US government shutdown, which we're on to day 16, and it's really showing no signs of easing up anytime soon. There's votes that took place yesterday, just not moving in, or no sense that there will be anything other than a prolonged shutdown, which means a vacuum for US data. And it also means that we don't hear anything. Well, we're not hearing anything from the Federal Reserve because they've entered their blackout period. So we're sort of in this time where we're not getting any fresh US data. We're not hearing from the Federal Reserve. So the market is very much going off other drivers. Now, obviously, the Fed cutting rates would be a positive catalyst. So we're not seeing that. Instead, we've got focus on the China trade concerns. Also, there was some worries over stretched valuations as we head towards earnings season. We've even had Federal Reserve Chair Jerome Powell warn of overstretched valuations. And so this all sort of comes as we're heading into the start of earnings season. Now, the latest catalyst, which is driving the stocks lower on Friday, is the earnings from regional banks have raised concerns. I've seen some big drops. Xeon and also Alliances is down 13% and 11% respectively following their results, owing to concerns about sort of credit risk. Now, this sort of has a whiff about it of 2023, when we saw regional banks coming under a lot of pressure. Interestingly, it came as the major banks, JP Morgan, Goldman Sachs, Bank of America, posted incredibly strong results, encouraging results, thanks to their investment banking arms, thanks to their trading arms, which outperformed, as we're seeing, a real return in investment banking activities and deal making activities. So whilst major banks have really impressed in earnings season, regional banks have just really raised some concerns. Now, that's the market's going to stay focused on earnings as we head into next week for clues over how the US economy is holding up, how the US consumer is holding up, whether there are any risks that can be noted. And that's going to be coming out in earnings seasons. We've got quite a lot of stocks to be watching. We've also got the start of the Mag 7 earnings, which we've got Tesla, we've got Amazon, and then, although not part of the Mag 7, we do also have Netflix earnings as well. So I think the other thing just to bring to your attention, and maybe we'll come back to gold in a second, but just as far, let's just have a quick look at the TA on the S&P 500. We're still trading within that rising channel within which we've been since the mid-May, but we are just testing that lower bound, the rising trend line, which is also the 50 SMA. We're seeing the momentum has actually fallen down. So, you know, this is a pretty key level we'll be watching here. If we get a break below here, and then this is Friday's lows, that was last Friday, then that's around the 6,500 level. That's going to be key because that will create a lower low, changing the structure of this chart and bringing 63.60 into focus. The other one to talk about, I mean, it's been everywhere, right, is gold. Gold has had a phenomenal week. It's up around, I mean, look at that parabolic rally in gold. A couple of factors going on with gold. I mean, it's up, first of all, 8.9% across the week, marking its strongest weekly gain since the Lehman Brothers collapse in 2008. That gives us a sense of how nervous the market is. A couple of things that it's boosted here. You've obviously got safe haven flows because of, as we mentioned, US trying to trade jitters, the US government shutdown, which is still ongoing. And then you've also got thrown into that the concerns over what's called the debasement trade, so the devaluation basically of currencies, as you know, as governments continue to print money, and that just, you know, devalues trade. We've also got the governments need to continue printing money because they've got such huge debt piles. The only way to help get rid of those debt piles is to inflate them away. And that's the debasement trade. Basically, it's investors looking back to hard assets to protect themselves against devaluing currencies. So you're looking at gold here, you're looking at silver. Bitcoin has not benefited from the debasement trade as one might expect it to have. In fact, you know, whilst we've got gold charging on to fresh record highs, Bitcoin's trading down, I think, around 12% across the week. So really diverging from gold quite considerably. And then you've got, yeah, gold. I mean, it's record high, $4,379, very overbought for a very long period of time. I mean, it's been overbought since beginning of September. So we would expect with this that you would then get a period of consolidation or indeed a move lower in order to bring that out of overbought territory. Currently, support levels, I mean, there is no, you know, this is just, as I said, a parabolic rally. Next level, maybe 4,000 on the downside. That's, you know, quite some way away. That could be potential. And then, you know, below that, you've got what, 3,800. But, you know, broadly speaking, this is a very bullish positioning. Again, looking overstretched, but I think the longer term outlook for gold potentially remains supported by those fundamentals and the fact that central banks continue to buy. So the fact that central banks also buying suggests, you know, this move away from the US dollar, de-dollarization into harder assets. This has been one of the big stories across the week. So let's just focus now on what we're going to be watching next week. I'm just going to kick off with the UK because obviously we're not going to get too much US data out at all. In fact, the only thing US data wise will be coming through will be the US CPI, which for a special reason they're having to report on next Friday as a bit of a one-off for the government, because the government remains shut down. But before we kick off all that, let's start with the UK. Here's the economic calendar on our page. I have just filtered it in line with what we're going to be with the highly impacting thingy. So Monday we've got China. We'll come back to China in a second. Tuesday, Bank of Canada. Wednesday we've got UK CPI data. Okay, so and then we've got retail sales on Friday. So UK CPI is expected to peak at 4% in September. And then drift lower across the rest of the year, according to the Bank of England. Inflation in August remained steady at 3.8% year on year, which was unchanged from July, whilst the thing to remember is that actual food inflation is rising at around 5.1% annually. So that's very much keeping household finances under pressure. I think even if inflation does come in lower than expected, the Bank of England is not expected to move on interest rates anytime soon, given that inflation is still almost 2 times the central bank's 2% target, and given the uncertainty surrounding the upcoming November budget. Also, we have retail sales. Now, we saw sharp declines in retail sales in the UK in April and May, but more recent data suggested that consumption rebounded in May, June, July, rising 0.4 and 0.5%. Respectively in June and July, and again 0.5% in August. That was basically clothing sales, thanks to decent weather and back to school spending. But consumer confidence did fall sharply in September, suggesting that we may see now the start of the cool down. Let's not forget that PMI data was also weak in September. We started to see a real slowdown there, and we've got UK PMI data this week as well. So the market will be looking to see whether that slowdown, particularly in the sales in the dominant service sector, continues. And finally, we've also got the latest UK public sector borrowing numbers. So basically, the most recent borrowing figures highlighted that the challenges that the government is facing in balancing the books, and maintaining fiscal credibility ahead of the November budget. So we saw that 18 billion number. It was lowered in a revision, but it still remains significantly above estimates, and taking borrowing figures for the fiscal full year to over £80 billion, a record number outside the pandemic. And one above the OBR estimate. So that means that the government really is facing struggles to balance those black hole or spending gap that we're seeing to the region of 20 to 30 billion pounds for the Chancellor. Now, we know that in previous attempts to cut spending, the government ran into problems with their own MPs, meaning that tax hikes are likely. Now, the Bank of England, as I mentioned, is not likely to move or to do anything as far as rates are concerned until it knows what the fiscal backdrop it's dealing with looks like, and that will be after the budget in November 26. Now, this is the pound that we're looking away from that high that we saw at the 136 137.25 level in mid-September, forming a series of lower lows. We fell to a low here of what, 132.50. Has recovered back above this point here, which is the sort of 133.70 level, support resistance level, now as a support level. Testing here the rising trend line dating back to April. Also got the 100 and the 50 SMA there as well, around the 134, 135 level. So that's the next level for buyers to look to retake. If buyers can retake that level on some sticky inflation data, strong retail sales, lower government borrowing, that could all help the pound push above here. But I think, you know, fundamentally speaking, the UK is not looking particularly strong at all. The rebound that we saw in the pound this week is much more to do with US dollar weakness than it is to do with notable UK strength. And so if we do, you know, we see the dollar did have quite a weak, a soft week. It fell by the most that it has in several months. So that's really fueled that recovery in sterling US dollar, but I think, you know, it really will struggle to make any meaningful rise above where it is. As far as support is concerned, 133.70 down there, you've got the 132.50, which is the low that we saw at the beginning of the week. A break below here opens the door to 131.50, which is the low from July. Also, just taking a quick look at the FTSE whilst we're here. The FTSE is falling sharply today. Banks are taking a big hit. Just again, we're still within that rising channel. You know, let's not forget that this channel has been going on some long time, since April 2024, of this year. So, you know, that uptrend is still very much intact at the moment. We can see that longer lower wick there, which is an encouraging sign, suggesting that there wasn't much demand at those lower levels. But it is the banks that are feeling the heat. Now, UK banks are reporting next week. We've got Barclays Bank, NatWest and Lloyds all giving out their numbers. Right, let's just take a quick look now at the US. We've had a look at the S&P 500. Just going to bring up here now the NASDAQ, because as I mentioned, we do have a couple of things going on in the US next week. We've got the US CPI inflation data, and also earnings from the likes of Tesla and Netflix. So just as far as US CPI is concerned, the government, obviously, as I mentioned, is still in shutdown, so most US data has been delayed. There are some exceptions, and as I mentioned, this September inflation report will be one of those. It'll be available just in time for the Federal Reserve meeting on the 28th and 29th of October, where the Fed is expected to deliver another 25 basis point rate cut. Now, we did hear the Federal Reserve Chair Jerome Powell warned over weakness in the jobs market, and he highlighted that over inflationary concerns, which really drove the market to expect another 25 basis point rate cut in October and potentially another in December. But it's also worth noting that US Q2 GDP was solid at 3.8%, which in itself could add inflationary pressures, as could Trump's tariffs. So August headline inflation, that rose to 2.9%, up from 2.7% in July, whilst core inflation remained unchanged at 3.1%. Also worth noting, the data comes as there are divisions opening up among FOMC policymakers regarding the next move. So, I mean, as I said, Fed rate cut expectations have really been helping drive this rally higher. We're in the NASDAQ. This is the rising trend line. It's still very much within that, above the 50 SMA, hovering just below the midpoint of the rising channel. Here we'd really need a break below that sort of 24,000 level to create a lower low and to bring 23,500 into focus. On the upside, 25,200, rise above that and brings us a higher high. Other things to be keeping in mind when we're talking about the NASDAQ is we've got Netflix. As I said, Q3 numbers on the 22nd of October. Expectations are for $6.95 of EPS on revenue of $11.52 billion for the quarter. And basically, I mean, in a that would mark a 17% increase in operating margin to 31.4%. So basically, as far as content is concerned, Netflix content slate is more backloaded for the year, so that is good news. Although selling pressure has come recently as Musk, Elon Musk, CEO of Tesla, planned the company for its more woke content, and revenue is expected to become Netflix's biggest primary driver in 2026, and also expecting limited churn from accounts. As far as Tesla is concerned, let's just bring up Tesla. So Tesla is expected to report Q3 earnings. They come as the share price has just fallen down from its recent low. We do still have this uptrend though, very much intact here. Let's just make that clearer. There we go. So it does still look relatively encouraging. We've got a support in there, but as far as data is concerned, the deliveries in Q3 beat forecasts, so that's what we saw giving shares a boost. The second quarter, we did actually see them initially tumble back after earnings because of a 16% decline in revenue. Total revenues were down 12%, but operating margins were higher than in Q1. So a couple of things to be watching out for then, operating margins, continued improvement, and also revenue. But as I said, deliveries in Q3 beat forecasts, which is always an encouraging sign. Just as far as levels to be watching, we're going to be watching out for around the 407 level on the downside. That's a sort of support level down here, 410 to 407. And then on the upside, a break above the 469, which was the high that we saw in October, could create a higher high and help the share price go back up towards this level here, which is the 488, which was the high that we saw back at the end of December. So we've also got PMI data. We're just going to have a quick look at Euro US dollar and what's going on here, because it is attempting to break out in a chart that's not so dissimilar from the GBP USD. I think the stability of the pound, of the euro, is gaining attraction given the weakness that we've seen in the US dollar. Japan's yen has obviously, it's playing to its own tune. There's political drivers in focus there, but this is the euro US dollar, which is just testing that 117 level once again, which is the 50 SMA. It's a level that the market really struggled to push against back in August, but it's just breaking out of this near term or attempting to break out of this near term downward trend. As far as what we're watching for the euro next week, we've got the PMI data. Markets are going to want to be seeing ongoing acceleration in growth. I mean, I say acceleration in growth in the business activity, the composite PMI. I mean, it is only at 51.2, which is, I think it's pretty good as far as the Eurozone is concerned, but it's obviously relatively stagnant growth. So that's, if we do get stronger than expected PMIs, especially in that service sector, then we could be looking towards that 1770 level and the 1830, which was the high that we saw back in July. On the downside, level to be watching 1550. That's the one that we get a break below there. That's going to create a lower low. Just going to have a quick look at. Oh, we'll have a look at oil actually, because oil is breaking out of this wedge here. We've seen it falling. I mean, it's just found some support on that lower trend line, lower bound of the falling trend line. Concerns here, obviously we've got US-China trade concerns. US and China are the biggest consumers of oil. We've had inventories which grew by more than expected, rising 3.5 million, which has which is, you know, raising concerns over the demand outlook. You've also got, you know, potential talks between Russia and Trump coming, Putin and Trump in the coming weeks, which could see the risk premium fade further. We've had the ceasefire in Gaza and between Hamas and Israel, which again is seeing that risk premium fade. So there's quite a lot of that's just. Oh, and also India did pledge to Trump that it would be would stop buying Russian oil, but actually the market is finding that difficult to believe, which is why it hasn't offered support to the price. So that's another one to be watching. And then we've also got China. We've got quite a lot going on in China, so that can affect oil prices. We've got the fourth plenum meeting, which runs from Monday to Wednesday. Primary focus is going to be on China's 5-year plan, covering developments between 2026 and 2030, and unveiling sort of key themes about consumption and development and growth. Also, we've got quite a lot of data. We've got the People's Bank of China not expected to move on rates. We've got Q3 GDP, which is expected to be released, as well as retail sales, which are expected to come in weaker, industrial production and fixed asset growth, all likely to show that China slowed substantially to around 4.5% year-on-year growth, which with no fresh stimulus measures is reason. Therefore, we could expect things to remain pretty weak. Now, this is the Australian dollar, US dollar. So we did see this rise up. I mean, it was being supported here by the 50 SMA, rose up to that peak there of 67.00 and has eased lower. Currently finding the 50 SMA, so it's just trading in this holding period. The RSI is pointing lower, but we do have these lower wicks on these recent candles, suggesting that actually selling price demand at these lower levels was pretty weak. So that could be an encouraging sign and may help the price rise above the 50 SMA at 65.30. Obviously, it's China data. If we get weaker than expected China data, that could make the Aussie dollar come under pressure and test the 200 SMA at that 64.30 level. Well, listen, that's all we've had time for today. I hope that you've enjoyed it, and I look forward to seeing you next week.